The European Central Bank has today matched its British peer, the Bank of England, and maintained interest rates at 0.5%. On the phone with me now to discuss the rate decision and the following all-important press conference is Martin van Vliet, Senior Economist at ING. While no interest rate cut was made today, Martin, ECB President Mario Draghi did state that the ECB will maintain current or lower rates for an extended period of time. Markets will now be attempting to forecast if and when further cuts could be made. What are your forecasts here? And similarly, how important is this commitment by the ECB?
I think this is very important. In fact, I think this was quite revolutionary what we saw today. And for the first time, I think in ECB's history, the president gave explicit forward guidance on interest rates. Previously, any ECB president had always said, we never pre-commit. But now he gave explicit forward guidance. He said we expect rates to remain low or they could even be lowered. So it was revolutionary in that respect. In terms of what we expect regarding interest rates, I think the most likely scenario still is for rates to remain unchanged. So for no further cut in interest rates. But it's fully premised on the view that the Eurozone economy will gradually start to recover later this year. So if no recovery unfolds, if the recovery does not materialize, then indeed the main policy rate, for example, the repo rate, could be cut further from its current already low level of 50 basis points.
As one spectator commented in the press conference questions, how similar was today's statement to the one presented in June? Is this to the detriment of Mr. Draghi and the ECB committee? And do you think comparisons to the Bank of England statement today are fair?
Well, yeah, there was a journalist suggesting that it was a sort of a copy from the statement of June, but apparently he hadn't listened right, and that's also what Draghi said. In fact, there was a sea change. This guidance, this phrase that the ECB expects rates to remain at current or lower levels for an extended period. That was something new, and indeed, the Bank of England also introduced similar phraseology in its statement earlier today. So, yeah, you have the suspicion that they sort of coordinated their statements earlier today. But this particular spectator hadn't really listened to what Draghi was saying. In fact, it was quite revolutionary, and I think it also applies to the Bank of England.
Portugal did not feature heavily in this discussion. Was this surprising?
Well, yeah, in one regard it is, obviously, because in recent days Portugal has come back into focus. I think the statement of Draghi, but also the discussion in the Q&A was mainly about the forward guidance given by the ECB and the reason behind that. And he basically referred to the increase in money market rates and the increase in bond yields in the Eurozone. I think the increase in interest rates and bond yields was mainly a global phenomenon. It's related to the tapering discussions in the US, and not only in recent days Portuguese bond yields have picked up. So that explains why everybody was sort of focusing on the specific statement and the developments in the financial markets related to the tapering discussions. But in fact, the interesting thing is that the ECB did include a new downside risk in its statement, downside risk to the growth outlook, and that is basically that financial conditions have tightened. And I think the turmoil surrounding Portugal can be included in that specific phraseology. I mean, it's also, the renewed escalation of the euro crisis could be also regarded as this specific downside risk. So it was a bit hidden, his reference to Portugal, and in the discussions, nobody was talking about Portugal, but in fact, it may have played a small role.
So, Martin, if, as you say then, that the best case scenario is that rates remain unchanged, what specifically are you looking for, and what could prompt the ECB into action?
Yeah, well, as I said earlier, I think if the recovery does not materialize in the Eurozone, then the ECB might be forced to take new interest rate action. So as long as the recovery begins later this year, then rates will probably remain unchanged. But specifically, I look at, for example, the credit growth statistics, which is sort of the monetary pillar of the ECB. If credit growth remains in contractionary territory, then it will be very difficult to envisage a scenario where the Eurozone economy starts to recover. So I keep a close eye on those specific statistics. In fact, if you look at credit growth numbers, they have tended, the cycle in credit growth has tended to lead the interest rate cycle in the Eurozone. So if the credit growth numbers would significantly weaken from already depressed levels, that could be the trigger for the ECB to cut interest rates. So I would advise everybody to take that on board and look at its monthly M3 report of for the ECB for this bit of key information.
I'll be back tomorrow to see how this event and others will have shaped the trading week in the weekly wrap-up interview. I'll see you then.